people are asking, is AI hype? No, it's here. Now, there'll be some winners and losers for sure, and we'll have some price pullbacks in there, but innovation keeps on trucking along. The industry's changed. There's going to be new players, new companies you've never heard of that are going to be the winners in the next 20 years.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, no small talk, no banter this week. There is so much news to get to. We're going right in. And leading off this week, the shutdown continues just about a month now. Here's a headline from CNBC. Largest federal worker union urges end to government shutdown. This is the American Federation of Government Employees, and they're basically issuing an ultimatum to Senate Democrats saying, take the deal Republicans have been offering, the so-called clean resolution. Hey, let's just throw some more money out there. These other issues, we'll have to slug it out later on those. But let's at least get the government back open. Hard left leadership versus the more moderate rank and file, I think, is what we're seeing.
Well, I think you're starting to see this game of chicken play out. And what was, the Democrats had the media upper hand in the early weeks of this, and it was, trying to say this was about health care. Well, the last 20 times we've done this, we've passed clean resolutions and then negotiated in good faith for whatever the issue of the day was, right?
Yeah.
But now that we've had federal employees miss a full month of paychecks, things are getting a little bit different. There's a little bit different pressure. So now it's moved to SNAP benefits, right? Food stamps, as they're trying to talk about. But the government workers need their paychecks just to go about their lives. And so they are now going to put a lot of pressure on the Dems to, hey, go get this done. And there's a couple of Democratic senators that are willing to, John Fetterman most notably, willing to come across the table. I just think that they need to schedule negotiations if they are with the Republicans and say, okay, we'll start negotiations next Tuesday, right? And we'll have 3 rounds of it, tell the media this so that at least you're bringing something to the table to get this done. Because the government shutdown just hurts everybody in the long run. And again, it's much ado about nothing we talk about, because any of the furloughed government employees, guess what happens? We're going to pay them anyway, right? We're going to back pay them, but it does create disruption. It's going to create disruption in our economy if this goes on much longer, retail sales for Christmas, holidays, et cetera. So we'll see where it goes. But yeah, the upper hand is now back in the Republican side, at least in public opinion, according to CNN's most recent polls.
Speaking of pain and disruption locally, David, some bad news for Fiserv.
Yeah, Fiserv, which has still, I believe, almost 4,100 employees here in the state of Nebraska. We have many clients that have worked there in the past, retired, and we have many clients that still work there now. Well, they unfortunately Wednesday morning reported earnings, and it was not pretty. They missed. And not only did they miss on the earnings, they gave guidance about 20% lower for next year, the fiscal year, than what they had been telling the street just 90 days ago. So the CEO kind of fell on the sword. This is not what's expected. But, I mean, if you're an employee, you probably don't care, because they woke up and their stock was down over 40% at the open, down 44% as we speak today. We got a chart on there showing only down 38%. That was a snapshot from a little earlier in the morning. And, so imagine, and this is one of the companies that rewards its employees with equity, basically through what's called RSUs, restricted stock units. And we have clients that have accumulated hundreds of thousands of dollars, in some cases millions of dollars in shares in this company. Well, 40% of their net worth, if it was all tied there, which is what we always tell clients about, has been eroded. Now, most of our clients, we've been diversifying them and working them out of it for years, so it's limited disruption to the folks that we've already been working with and de-risking. But if you are an employee of this company right now and you're just looking for guidance, just call in, schedule a 15-minute with one of our licensed advisors. We can talk you through what this looks like long term. The stock has had retracements before. It's a quality company. They just got to get some stuff figured out. So it's going to be a little while before you get back to those highs.
So let me see if I understand. Almost half the share value, though, wiped out on October 29th. At least that's the announcement.
When you work with a fiduciary, we have what's called the prudent man rule. You cannot have a chunk of your net worth, typically over 20%, tied into one asset. It's just too much risk on the table. And we just go back to L3, Enron, right? Folks in Omaha remember this. We've had employees go through all those disasters, and so make sure you work with somebody who understands how to work out, without paying too much in taxes, by the way, how to liquidate those shares in a timely fashion if you are highly concentrated in any company.
Now, meanwhile, in the housing market, some good news. You sent the team a chart showing a positive month after what had been a negative run, although you're not sure if this is sustainable.
Yeah, so, I mean, 1 month does not make a trend, but 3 months consecutive, the longest we've had reported in history. We had 3 consecutive months reported of negative price action on houses year over year. We just had a positive month printed, so that's just showing some stabilization. And the reason for that is interest rates have come down. So the 10-year finally broke 4% earlier this month and is kind of teetering right around that level. But interest rates on mortgages are at the lowest level they've been in over a year. And so that is at least starting to get some activity, movement in the housing market. But it's most likely, if for those of you watching, you can see the chart. That's a pretty good trend line. If you just drew a trend line on that chart there, I still think there's more negative months coming, and housing is going to have to go through a bit of a correction to get this worked out. So I think there'll be more negative price action in the coming into next year as the listings keep mounting up. There's tons of them. We talked about the ones in my neighborhood. Finally, the one I talked about on the radio here, he gave up and just leased the house out. Finally, is not selling. Is going to wait for another day because anyway, mispriced it from the get-go.
Social Security announcement for 2026. David, here's the CNBC headline. Social Security Administration announces 2026 COLA benefit increase of 2.8%. Is this a surprise or was this expected?
Right in line with what we were expecting, 2.8%. And just so you know, that's the historical number. If you go all the way back to its inception, that's the average COLA raise on Social Security.
Cost of living adjustment, of course, is what COLA stands for. So
basically, if you were getting a $2,000 a month benefit, you're going to basically end up, with 2.8% more on top of that, or basically about $56 added to your benefit for $2,000.
I guess as long as inflation is under control, that's okay. But boy, if inflation ever fired up again, that 2.8% isn't going to do much.
Well, yeah, if you remember, we had inflation peak out over 9% not that long ago. Yeah. We didn't get a 9% bump in the Social Security COLA. So, but anyway, it's not going to keep up with your retirement. You need to have a true income plan in writing, inflation adjusted, so you know where your income's coming from.
David, I'm going to throw you a package of PayPal items and then let you sort through it for us. The first one was about PayPal stock being down, even though revenue was up, which you said was a sign of, your words were, insanely bad management. But then we have a CNBC headline about PayPal shares surging 13% after an OpenAI deal. PayPal is going to become the first payments wallet in ChatGPT, and you're wondering if that will be a catalyst for PayPal going forward. Take us through these items.
All right. So, ironically, we're talking about two companies that employ quite a few people here locally. We were talking about Fiserv earlier, who's taking it on the chin right now.
Certainly PayPal.
Well, and PayPal here as well. We have several clients that work there as well. Well, PayPal stock, if you don't know, we have the chart on the YouTube channel now. It was up over $300 just a few years back, right? And so that stock got clobbered all the way down into the $50 range and has basically been basing in about a $20 range for the last several years. So it kind of went through what Fiserv is going through right now already. Their shareholders have already gotten that shellacking. However, they've grown their revenue, and that was one of the things I posted to the team. They grew their revenue by $11 billion over that time period. So they're growing sales, they're growing what they're doing, but they were mismanaging expenses under the hood, so they weren't getting the earnings growth. And now with the efficiencies they're getting in there and they're reducing headcount, things like that, they are looking. And I sent a technical chart out to the advisors. Now that's not the chart we're looking at. We're looking at a long-term price, but I literally gave the advisors a very technical chart of where the price action would go. And then lo and behold, the next day we got news that they basically signed on with OpenAI and will be the first, payment services offered through ChatGPT, and that popped the stock significantly in one day, about 14%. And so that may be the catalyst that breaks it out of its technical funk. So they're on the upswing. There's the chart now. We've got it pointed up. So if it crosses that line there, that trend line, long-term line there, that's basically going to create what we call a cup and handle that's formed over multiple years. That is a very powerful technical formation. So if the fundamentals thrust a stock through and volume comes through, that's an indication that we have institutional interest in buying and acquiring this stock, and that's what moves the price of a stock ultimately. So growth in earnings and institutional sponsorship, and that is something PayPal has lacked in recent years.
Okay, but what is the advantage for the consumer and for PayPal for PayPal to become a payments wallet in ChatGPT?
Okay, you need to understand how much action is going on inside of these LLMs, ChatGPT being the most popular, right?
What's LLM?
Those are the AI learning models, right? So you've got Grok, Gemini, Anthropic, Claude, ChatGPT is the bigger brand name that's run by, of course, OpenAI, which Microsoft now owns a big swath of. That was big news for that earlier in the year. So if transactions are now going to be able to take place in there, you're going to be able to pay for things, right? More search is going on. And if you just look at Google search numbers, they fell off a cliff as the use of ChatGPT went up. So people that don't even understand how to use these tools correctly yet are using them for basic search items. And if they're going to get commerce through there and they're going to be able to start purchasing things, you're going to have to pay for something through there. Well, the company that gets to take their little swipe of each of those transactions is obviously going to benefit greatly. So what if just your ChatGPT, and we just, full disclosure, I have a business account for them. So we have a business version of that where we pay them monthly subscription fee. What if the only way they take that payment is instead of my credit cards, I have to run it through PayPal? I don't know what's coming, but they can make that decision. Would PayPal benefit? Absolutely, because it's guaranteed tractions, guaranteed revenue. Nothing better than a company that can have guaranteed revenue streams from an monopolized audience. And that's the things that Berkshire Hathaway loves to invest in. They love investing in things that have monopoly pricing power, which is why Coca-Cola has been one of their favorite investments over the years. Coke is Coke, right? There's no other soda that can compete with it. And so anyway, that's, it's just could be good for the upside. By the way, we're not making any stock recommendations, buy, sell, et cetera, here on the show. I'm just talking about because we have clients that own these. And I just thought it was interesting in the same week. Good news, bad news on two competing companies in the same space that happen to have a lot of employees right here in our home state.
Up next, our division called Tax Smart is putting on a workshop for entrepreneurs. Here from Tax Smart to tell us about it is Evan Marshall. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Are you an entrepreneur in need of tax and exit planning? We have a workshop for you. One of the presenters is with us today. David, please welcome Certified Public Accountant, Certified Exit Planning Advisor, and Director of Tax Smart, Evan Marshall.
Yeah, thank you, Chip. Joining me in the studio once again is our Chief Tax Strategist and CPA extraordinaire himself, Evan Marshall. Of course, you're not really in the studio, are you? You are somewhere on the South Shore of Jersey hanging out with MTV folks. Is that what's going on?
Yeah, me and Frankie Valli had dinner last night, and it's been a good time out here.
All right. Now, Frankie Valli, which I actually was blessed to see when I was a senior in high school, perform live. So tell me this. Have you seen the movie Jersey Boys?
It's been a minute, but yes.
Okay. All right. So Clint Eastwood did a great adaptation of the Broadway play. But anyway, it's a good story telling the story of, Frankie Valli in the Four Seasons. And of course, Joe Pesci's, one of the guys actually really discovered him in real life. Neat story. But anyway, enough about Jersey. All right. Let's talk, Evan, taxes and the IRS. The government, as we record this, is still shut down. We are going to be approaching the longest government shutdown in history here in less than a week. So how is that affecting people filing? Obviously, they still have to pay their taxes on time, et cetera. Quarterlies still go in, all those type of things. Can you talk a little about the disruption from business tax returns that were just filed, from people that did extensions that just filed? The money, you still have to send it in, right? There's no forgiveness there just because no one's there opening the envelope, right?
Yeah, so we're getting some questions from clients who are maybe trying to be a little creative with the government shutdown, but just to be clear, all of the filing and payment obligations still are put in place, even under a government shutdown. So what the government shutdown is really doing is, it's limiting what they consider non-essential employees, but there's still essential operations that still have to take place. Like the mail still has to be delivered, TSA still has to operate, but the IRS currently, a huge portion of their workforce has been impacted by this government shutdown. So, right now people aren't really there to open up the mail. Customer service and the phone lines are really getting impacted. There's still a few people there, but like, for example, I was calling the IRS to help a client with something that they're running into on their tax issues, and I was on the hold for over 90 minutes before I was able to talk to somebody. Now, kind of par for the course with all the cutting that the IRS has been seeing recently, but just to make it clear, like all the filing and payment obligations are still put in place, but we anticipate that's going to be a pretty big backlog for all of the paper filings that the IRS just hasn't been able to get to, and we could see this having an impact for many years to come.
Yeah, so speaking of that impact, and it may not necessarily affect our clients as much because they do not typically are not the folks that are unfortunately living paycheck to paycheck. But a large swath of our population in America, we know, is unfortunately living paycheck to paycheck. And what they look forward to in the spring every year, late February, early March, is they're the early filers, right? You can start filing in the third or fourth week of January. They have simplified returns, so they get them in, and they're usually the folks that are getting tax credits, whether it's earned income credit, child tax credit. So even if they didn't pay in a bunch, they end up getting a pretty healthy refund. And a lot of people look forward to this because it's their vacation fund or it catches them up with their credit cards from the Christmas. So do you anticipate those refunds being delayed we're talking several months now, but because of this delay now?
Yeah, so the IRS has been making pretty good progress on, shifting to more electronic processing and payments. Actually, earlier this year, they essentially shut down the paper processing of refunds to make it more electronic. So what I would say to that is, for those who are electronically filing their returns and doing direct deposit for refunds, I don't anticipate a material impact for them on the timing of getting those refunds. But, we do see some maybe older clients, maybe more technologically adverse clients who, maybe still paper file their tax returns, anticipate a paper refund to be coming to them
we had
in the
two
mail.
this year, Evan, and I think you saw one or two of them. Because every prospective client that comes in, we have them bring their tax returns. One of the first things we analyze. Well, we had two that literally not only do it in paper, literally filed it with a number 2 pencil, filed their tax return with a pencil, right? And I'm like, somebody could erase that along the way. But anyway, so there are going to be quite a few people then are probably going to be impacted. Hopefully that will be limited there. So I don't want to get up too much time on this, but I appreciate you keeping us up that, hey, look, you still got to pay your payments on time. Nothing has changed as far as the rules of the road for that regard. But the rules of the road did change in July when the BBB, the Big Beautiful Bill as it's called, went in, and that does affect a lot of our philanthropic clients, those that give to charity. I do it. My wife and I are charitable givers. Our company is charitably inclined. We have tons of clients. So there are changes coming to the way you can deduct for those that are on the higher income brackets, tax deductibility of charitable gifts. So one, I want you to talk a little about why making larger gifts this year could be a really smart thing to consider. And there's vehicles you can do that if you just don't want to write the check straight out, right? So you can spread that gift out for the next couple of years. In other words, you just might want to lump gifts together in like a what we call a DAF, a donor advised fund. And then talk about the deductibility going forward, limitations of that new 0.5% rule.
Yeah, absolutely. So the One Big Beautiful Bill luckily kept a lot of things consistent from 2025 to 2026, but there were a few wrinkles that did change. One of those included how charitable deductions are going to be impacted starting in 2026. So starting in 2026, the One Big Beautiful Bill Act actually says that any charitable deductions so you can only actually deduct your charitable donations that exceed 0.5% of your adjusted gross income. So, and I'm doing public math here. So if your adjusted gross income was say $200,000 and you took 0.5% of that as a floor, the first $1,000 of your charitable giving in that scenario wouldn't be deductible. Now, again, that's effective in 2026. So we're educating clients, for 2025. If you want to get the full benefit of the charitable giving and want to accelerate some of that into 2025, getting to deduct every single dollar, assuming you itemize, right? There's ways to accelerate that. You mentioned donor advised funds, but at least we're educating our clients here in the Q4 that, hey, this is something that's going to be impacting you if you are charitably inclined, and so it might make sense to accelerate that. Additionally, we're talking about with the SALT deduction impact on the One Big Beautiful Bill Act, that cap under our state and local tax deduction, that went from $10,000 all the way to $40,000 in 2025. Again, another incentive to maybe try to bunch charitable giving into a single year, maybe bunch multiple years worth of property taxes or to get the full benefit of 2025 for those who are anticipating that they're going to be itemizing.
Absolutely. That's some great advice. Now, and so they can just get a hold of you if they've got some more questions on what they could be doing here for year-end tax tips. And I also think it's important that smaller charitable organizations, smaller churches that are receiving these gifts and tithes, understand the budgeting process. They may get bigger gifts this year because of this, and they may not get that same gift next year. So it's important, I think, just for those that are on the receiving end of these gifts to understand you may get some people that give you a bigger gift, but that's going to be next year's gift or even the next 3 years' gift included. Make sure you're budgeting appropriately and being a good steward of those dollars. Because I got married in a church that, if you missed on Sunday, you were put on a new committee as punishment, because there's only about 60 people that showed up on Sunday, right? And the North Kissimmee Baptist down in Florida. But anyway, so I just know how some of those organizations don't maybe look budget out on when larger gifts come in. All right, let's pivot real quick. One of the exciting things we added here this year was our proactive tax and exit planning class. We have now 4 CEPAs in the building, certified exit planning advisors, including you and me, along with an estate planning attorney that we refer to as not part of our practice, but is also a CEPA, and then Mike Schudel, one of our most educated advisors. And we've put together this class for business owners. We've got one of those coming up here pretty quick, right?
Yep. So the next class that we'll be hosting will be actually on Friday, November 7th at 8:30 a.m. at the Midwest Learning Center. And, what this class is really trying to accomplish is have entrepreneurs who are, considering exiting their business either in the short term or in the long term, kind of think of ways to proactively put their position or their business in a best selling position. So we take it from all angles, like from you as the entrepreneur who have built and scaled multiple businesses, from Mike Schudel from the financial advisory perspective, and then myself as the tax planning perspective, to kind of get a well-rounded class to educate on multiple aspects that go into building, scaling, and helping build that enterprise value for a business, but also exit in a way that helps put more dollars back into your pocket and less to Uncle Sam. So with Q4 here, we will also be talking about some tax planning ideas before the end of the year for those who are actively managing their business. So there's going to be a lot of good education for those who own a business, or for someone who may know that owns a business.
So basically, a business owner that's got at least, say, $1 million in revenue or much higher, there's tips you can give them that they could go execute after this class and literally put some savings to the bottom line here in 2025.
Yep, absolutely.
All right, so if that's you out there, don't be shy. Sign up for that class. It will fill up. I do believe we'll have breakfast for you, and we promise to get you in and out in an hour. So we understand the life of an entrepreneur. Hey, Evan, the time has come and gone. We are out of time for this segment. We'll look forward to seeing you back live here in Omaha next week for that very class. All right, safe travels, my friend.
Thanks, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, first question, market versus economy. This is something that's been coming up. By the way, we're just about through. These are questions that were submitted at our September Speaker Series event. And this one reads, what is going on with the economy, given the disconnect between record market returns and the weak job market?
Yeah, so one of the things we're having to do is adjust how we look at the job market in particular. So we look at a lot of data, but what happens decade over decade, and again, you kind of remind me, I remind you as well how old we are, right? I've been doing this a while, right? And the data sets that we look at and the weighting that we have to give to them has to change over time. So productivity is increasing by a very wide margin. Revenue per employee at all public traded companies is increasing by a huge factor. So the job market is continuing to be weak. We see cuts from even the biggest AI companies, the Mag 7 companies, job losses. Amazon just announced, over 14,000 job cuts in its corporate center this past week. So we're seeing a very weak job market, but we're seeing incredible returns in the market, all-time highs again and again and again. So the economy is firing off as far as GDP is concerned. So the metrics that we measure it by, we're going to get a good GDP print here for this quarter, bigger than most expected, including myself earlier this year. So the productivity is coming through. So there is a disconnect. However, we're going to have to see what those job numbers mean, because now with the immigration policies, we have to readjust what we expect to be private sector jobs and growth acceptable. Where I would tell you that I'm always looking for about 250,000 jobs for most of my career to mean the economy was actually growing. That number is being reduced to about 120,000 now, because we have boomers retiring and we have
250,000 per month. right?
Yeah, that's what we used to think.
Okay.
Yeah, right. So we were looking for like 60 to 70,000 jobs a week. Now, literally, if we get 30,000 jobs a week, I think that's fantastic. Going to be for the economy because the jobs pay more, and the employee that gets hired is that much more productive, creating GDP for the nation. We're having boomers retire at record rates, about 10,000 people retiring every single day, Chip, and we're having immigrants that were not here legally fleeing or being arrested, one or the other. And so we've had, I think, about 1.8 million selected deportations, et cetera. And then you've had hundreds of thousands, about 500,000 people arrested thus far this year. So those people are not in the job market, right? So the good news, that means the worker that gets the job is likely to get a higher rate of pay. But yes, it is going to be a weak job market. So we talked about last week a K economy, right? Where the market for those that own assets, your life is looking up, right? If you own real estate, assets, gold, Bitcoin, you're feeling pretty good because the value of your assets is continuing to climb, even if we see a maybe a little bit weakness on the economy. But those that don't have assets that are just earning paycheck to paycheck are struggling mightily. And then those that were counting on those federal benefits we talked about earlier are feeling that pinch as well. So yeah, very, very bifurcated economy right now. And that's the best I can answer to it for now.
Next question, David, is about artificial intelligence. Do we see a bust in AI due to no workforce to build data centers?
I think at some point you're going to have a whipsaw back on, and we did this in the internet days and the e-commerce days. I don't necessarily think it's here yet. Data centers are being built. They take less employees to build them, right? It's construction, et cetera. And they're being built at a very, very rapid pace. And so I don't see that slow down in particular anytime on the horizon, at least not in the near term, next several months.
Next question, David, is about Roth penalties. Is there anything in the one big beautiful bill to allow Roth conversions without penalty?
So there's never a penalty to do a Roth conversion. So I want to make sure we clarify. However, what I think the questioner may actually be asking is there anything in that big beautiful bill that would allow you to do a Roth conversion without paying taxes is probably what they're asking. So there's no penalty to convert, but it is a taxable event. Now, there is a penalty if you were to, let's say you have $100,000 in your IRA, Chip, and you're 35 years old, and you decide to convert it to a Roth IRA. You're going to owe tax. That becomes $100,000 taxable income. So we'll just use 24% for simple math right now. So if that created a $24,000 tax liability, you have to write that check. However, if we were to withhold it, which is allowable, we could withhold the 24 grand and move and just deposit 76,000 in your Roth. There's no penalty there, right? That's a taxable. But if we did withholding, you would create a penalty because that's a premature distribution. You're not 59 and a half. That was 35. But if you're post 59, you can pay the taxes out of the conversion and there is no penalty. That's the only way you would incur a penalty is if you're paying the taxes on the conversion out of the transfer and you're not yet qualified age, which is 59 and a half years of age. Make sense?
Well, yeah, you're going to have to pay tax at some point in the transaction.
The taxes are always going to be paid, right?
But you've always said pay tax on the seed, not the harvest.
Absolutely.
Get it out of the way up front. In most scenarios, that's what makes the most sense. One more question, David. This one on tariffs. What will be the economic impact of a Supreme Court decision on the Trump tariffs? Well, this issue is percolating in the Supreme Court right now. I guess if the court upholds its authority, you just keep on keeping on. But if it goes the other way...
Yeah, and the reality is Congress, at least from the research I've done, has granted the president authority. Now, they have the right to take it back. You hear Congress people, including Don Bacon, it should be the House strings in the purse. You granted this position the authority to do this. Now, I think Rand Paul, actually in an interview about 2 months ago, had a very reasonable solution. The president can put tariffs on for a temporary time period, 30 days or 90 days, and then Congress has to say yes or no. And if they don't do anything, then he can keep his tariffs in place. But Congress would have to go in and vote on it. And so that would be some kind of compromise. Now, the question is, what would happen if the Supreme Court voted one way or the other? Well, I think they're going to see it Trump's way, and just reality of the way I've analyzed the data. But if they didn't, it would be absolute chaos because the refunds would be going out to countries all across the globe that would massively increase our debt. From all the money we've collected in tariffs would have to get refunded, and most likely the country would be sued by those countries to get interest payments on that money as well.
Oh my goodness! Because we've been celebrating the surge in revenue created by the tariffs.
It would be chaos, and it would be that would be a market moving event to be sure.
Okay. Up next, is a wealth tax coming to California? We explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, here's the headline from the Cal Matters website. Should billionaires pay more? California unions want voters to decide. So this would be a ballot measure in California for a proposed wealth tax of 5% of all assets, public and private, from billionaires. What do you think, David? Do you see this happening?
I think it's insane. I don't think it would be constitutional. I think they know that when they proposed it. But this is the reality we're in, right? We're watching what's happening in New York City right now with a full-blown socialist out there running for mayor, and you've got politicians lining up to support him, and he's promising free grocery stores, right? Free buses. It's just nonsense when you understand economics, sadly. And again, the way you help people is capitalism. It's proven for centuries. But anyway, here is what they're trying to do with this: is they're trying to get somebody to lose their temper, and come out against it. And then once they have it against it, this person is not for the little guy. And
political marker out there to use in a campaign.
Absolutely,
okay.
And that will be used for the next couple of years cycles, I would think, in there. But just so you understand what they're proposing, Chip, is a 5% tax one time. Not yearly, one time on all your assets, public and private. How do you value private assets? Who's going to be giving the number? What's your company valued at today when we want to tax it? Of course, we want that number to be as high as possible, or any private investments you have. And then where's that money going to come from? They're private investments. They're not liquid. That's what people don't understand. It's not like Elon Musk is sitting around with this big pile of cash because he's worth so much because his stock goes up, right? And we just don't teach basic economics in high school. And most people certainly don't take it in college, and we need to, because this is absolute lunacy and will drive. I mean, what's going to happen if that passes? How many billionaires are going to move out of the state of California, do you think?
They're going to vote with their feet.
Well, and we've already seen several of them
Texas
do it, right?
And other places they go.
And just, there's less than 1,000 billionaires in the country, but that's all the rhetoric you hear from Elizabeth Warren. And by the way, 71% of them are registered Democrats. But Elizabeth Warren keeps saying that, the Trump administration is just playing to all their billionaire friends. So you think they're doing the policy. I think 77 million people voted for the current administration. I don't care if you did or not. I'm just telling you the truth. When they say, it was only for the billionaires, there's only 230 Republican billionaires in existence in the United States, right?
Yeah.
So it's hogwash, and we'll never see the light of day.
Well, you stuck on the end of your message to the team, you noted Atlas Shrugged. That's the Ayn Rand novel, of course.
It should be required
reading in high school.
Absolutely. And if you've not read it, read it.
Well, because of her, and she lived in Russia, actually, under the Soviet Union, and it was about how a collectivist ideology took over in America and basically ruined the place, and the productive people just kind of went into hiding to bide their time until the system collapsed.
Now, I would tell you, there's a movie version, but don't watch it. It was so horribly done, sadly. It's a long book.
I thought it was all right. I've seen a few of those, but it is a long book. Anyway, now, okay, so let's go to the other side of the country and the other side of the spectrum and look at this headline and story out of Florida. This is from the Florida's Voice News. Florida GOP lawmakers pitch property tax reform. Representative Monique Miller suggests 10-year phase-out. You know Monique Miller from your days in Florida, right?
Yeah,
I think you mentioned.
Monique is a current friend and a former client of mine. Yeah.
Okay. And so what's she trying to do?
Well,
down in
if
Florida?
you've seen Ron DeSantis, the governor of Florida, is out there talking about property taxes is unreal. I mean, there's a post on him talking about, if you buy a TV at Best Buy, are you expected to go pay a tax on it every year? No, and you should be able to own your home, right? And it's the same thing. And I've got a picture of that quote off of Twitter there.
Our producer Shannon found this meme. Yes, in case you have trouble, or in case you're listening on the radio. If I go to Best Buy, this is Governor Ron DeSantis. If I go to Best Buy and buy a TV, I pay a sales tax, but I don't keep paying taxes on it year after year. And Shannon added, "No, Ron, don't give them any more ideas of making the sales tax recurring." But go ahead, finish your thought.
Well, the idea is property taxes, you and I have talked about it, should be theoretically unconstitutional, right? If we believe in ownership rights, which we do here, the rule of law, you can own things. And so they levy taxes on you for services they render, but then a just valuation that somebody says is the value of your home, which is not really the true market value. If you're not in the market to sell it, how can you put a value on it? And that's what they assess it. And I've complained many times here. I'll buy my house every 15 years. here in Sarpy County with the property taxes. It's insane. And so, we're going to see more of this pushed up in states that are conservative leaning with their fiscal spending. And just so you know, there's no income tax in the state of Florida. So they're going to do this already not having an income tax as well, right? So the proposal is a 10-year phase out so that the counties can shift how they get the revenue and put it to a more consumption-based tax. And there's multiple proposals. And by the way, she still leaves the school board taxes in place in there to fund public education, et cetera. And I don't necessarily agree with the way that's done. But here in Nebraska, just if you're not aware, we have the EPIC tax, and you can Google it and read about it as a potential proposal. But I think you're going to see a massive shift. And that's the wonderful thing about the republic, which is not a democracy. We live in a republic. By having 50 different states figure stuff out, the winning ideas win, and the population and the money migrates to where they win, and that we've seen
Texas
the last 5
Florida,
years. Yeah,
the last 5 or 10 years.
I think if something this gets through and it works, you will see more states copy or tweak off of it. So
I'll
good
tell
news.
you, as a state senator and a county commissioner, I ran into this because people say, well, the sales tax, that's the most regressive tax because the same rate is applied to everyone. Warren Buffett and someone who's struggling. I promise
you, I spend more money on restaurants, travel, things I pay sales tax on, right, than somebody who doesn't have my wherewithal.
Well, that plus the property tax is assessed without regard to, and you can sometimes get a homestead exemption, but basically I got letters and emails and phone calls from people saying, especially fixed income elderly, I've been in the same house for 40 years or something. In the last 10 or 15, my valuation has doubled, but my income hasn't.
Yeah.
So my property tax is going up and up and up and up, and it's killing me. It is the most brutally regressive of all the taxes. So any reform in that area would
be welcome.
Yeah. Hey, David, so you mentioned earlier in the Q&A segment the K-shaped economy, and you brought that up last week. I was not familiar with that term. Well, you sent the team an item further fleshing out this idea of the K-shaped economy.
Well, I briefly described it earlier. Those that own assets that are appreciating in value, what happens in a K-shaped economy? The economy is growing, asset value is growing, inflation actually rises the prices of inflationary items,
so there's
stocks,
your
real
upward
estate,
stroke
right?
on the
so
K.
people that own assets are doing well. They're the upward side of the K. The downslide is basically those that don't own assets that are getting further behind. Just the point you mentioned, somebody stuck on a fixed income and their property taxes and their homeowner's insurance, the cost to just live in a home they've already paid for keeps eroding their spendable dollars, what they can go to the grocery store with and feed their family with if they're stuck on a fixed income. And the chart we're looking at here takes a look at it in a very different way, still represents the K economy. You see the blue line on the chart is going up to the right. That's the S&P 500. The red line you see going down is the Michigan consumer sentiment scoring, right? Where the economy feels like it is to
We've
people.
We've cited that study often on this show.
And so people are really getting depressed on where they think things are going. And that's, understandable with the job market weakening for sure, but it's not as bad as you've seen. But we have a media dead set on selling what? Negative news, right? and this is on all channels. And that's, so if people put away the screens and put away their phones and just live their lives, they'd be much happier, in my personal opinion. But I mean, my kids, I struggle. They're in their 20s, they're grown adults, but the amount of, they cannot let go of the screen. I mean, for just a short period of time, it's an addiction that is going to need to be solved because this is changing the mental buildup of our country.
David, this next item, you're a student of history, and you sent the team. This is a cover from Barron's magazine.
This is an oldie but a goodie.
Back in May of 1999. Now, the context is there are some people kind of giving the side eye to the artificial intelligence phenomenon. This is just a passing fad. And so here's Barron's, May 1999, and the headline is Amazon.bomb, B-O-M-B. And there's an old-fashioned bomb with a fuse on it and the face of Jeff Bezos on this bomb. And the copy reads, "The idea that Amazon CEO Jeff Bezos has pioneered a new business paradigm is silly. He's just another middleman, and the stock market is beginning to catch on to that fact. The real winners on the net will be firms that sell their own products directly to consumers. Just look at what's happening at Sony, Dell, and Bertelsmann." Barron has lived to rue those words, David.
Yeah, and obviously, if you had invested with Amazon the day that article was printed, you'd be up over 15,000 5%.
That's a good return.
Not too shabby, right? So, the point here is the media, the talking heads on CNBC and Fox Business, et cetera, they don't always have all the answers. In fact, they're there to sell you a bad story, not a good story. And Barron's is, we call it bearish Barron's. Barron's, when they do a feature story, it's usually to the negative side. That's what they're trying to, that's what sells papers, right? And back then, they still sold physical papers, right?
Yeah.
Try and get a printed copy of that today. So the point being is, people are asking, is AI hype? No, it's here. Now, there'll be some winners and losers for sure, and we'll have some price pullbacks in there, but innovation keeps on trucking along. The industry's changed. There's going to be new players, new companies you've never heard of. They're going to be the winners in the next 20 years.
And so don't be cynical about AI, is what you're saying,
right? And
now.
Understand why you should have a diversified portfolio. If anything you get from today's show, do not be concentrated in any one area or one company, i.e., Fiserv, PayPal, etc. Have a diversified portfolio. Work with somebody who helps build you an income inflation-adjusted income plan so you can enjoy your golden years.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll talk to you next time. Go Big Red.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.
Or is it Go Big Black this week? And hopefully USC is black and blue.
Ba-dum, boom. Evan Marshall is a certified public accountant with Tax Smart, an affiliate of Smart Wealth and Retire Smart. The tax tips and strategies discussed on this program are for informational purposes only and should not be construed as specific tax advice. Please consult with a qualified tax professional before making any decisions based on this information.